Eric Wiklendt. Welcome to Built to Sell Radio.
Thanks for having me, John. I really appreciate it.
Yeah, as we were talking about offline, it's football day tomorrow. Are you watching Notre Dame?
I will be hopefully watching Notre Dame tomorrow.
How's their season going this year?
Yeah, they're 8-2, so they're thinking they might make it into the playoffs even with the 2 losses. I think to the chagrin of my sister, who's a University of Michigan graduate and football fan. But hopefully we get in and do all right again this year.
There you go. Well, we're not here to talk football as much as we are talking about acquisitions. So you are one of our inside the mind of an acquirer guests. You run a couple of different funds at Speyside. Maybe just to introduce yourself to our audience, walk us through what Speyside does and sort of what your investment thesis is.
Yeah, absolutely. Speyside Equity is a firm that is focused on acquiring lower middle market manufacturing businesses up to $500 million in revenue. We really like to find things where there's an opportunity to improve them, either to grow them through acquisition or organic activities, or to improve the margins through operational improvements, plan improvements, supply chain improvements, things of that nature. So we target things that are oftentimes in some sort of misaligned ownership structure or just people looking for an exit, depending on what's going on. It could be family owned, it could be owner operator owned. It could be owned by another large company and it's a carve out. It could be owned by a larger fund. It could be public. We've taken some companies private, things like that, or folks looking for recapitalization as well. So we like to do acquisition solutions and then transformations after we own the business to improve the business and create value that way.
Would it be fair to say, and I don't want to put words in your mouth, but would it be fair to say you're targeting kind of fixer-uppers or turnaround situations where there's some kind of hair on the deal and a bit of complexity?
Yeah, we absolutely love those kinds of things where structuring matters. We'll come in with solutions. We're really good at that. The 3 of us that are the partners of the firm, myself, Kevin Doherty, and Nick Lardo, we have really, really, really deep acquisition and structuring experience. So if it's a hairy deal, that doesn't scare us. If the seller has needs that need to be thought through and met, and other people don't want to do that, we will do that. Happy to do it. And then after that, we'll structure it for growth, for performance, and then in our ownership period, we will look to transform it and improve it in some way. So, yeah, that's exactly correct. So, if it's a situation where somebody has a business they really want to sell and they think it's going to be hard, call us first for sure. And then, if it's not hard, it's okay. Call us first there too.
I was going to say, because in many, you guys focus mostly on manufacturing companies, and they're recently kind of the belle of the ball. A lot of people are like the kind of bricks and mortar, the making physical stuff, especially in the world of AI, where everybody's worried that AI is going to take all the software jobs and all the intellectual property jobs, like the real making stuff. Obviously, the current government in the United States wants to bring all the manufacturing back, so that portends well for that industry. But it's certainly an industry which is well targeted by private equity. So how do you guys compete with the other folks who are also trying to buy small, mid-sized, mid-market manufacturing companies? Like, what's your unique sort of value prop?
Yeah, great question. So Kevin, Nick, and I have all been C-level guys at middle market manufacturing companies, and we really like to say we're a firm designed by operators for operators, and that's a little bit different. What you'll see is a lot of other private equity firms, folks come out of the investment banking world and go into private equity. We're a little bit different than that. Nick did a little more investment banking than Kevin and myself, but we've all operated businesses, so we have really strong operator experience. And then Kevin cut his M&A teeth in PricewaterhouseCoopers doing transaction services. He was a partner in that group there. And then I cut my M&A teeth doing corporate business development for Eaton Corporation. And so we kind of surround the whole thing in terms of being able to do deals. And we've all been at Speyside over 10 years, which is really, really helpful. So we have a lot of that deal experience as well that helps. But yeah, the thing that's really different about us is that we're much more operationally focused than the average PE firm, whereas a lot of other PE firms are financial engineering focused. We're much more focused on how is the business going to run better under our ownership, and how do we work with sellers to understand their needs in a sale. And we come at it more from an operational standpoint versus maybe a more pure financial engineering standpoint.
I'm guessing that when you're doing a deal, like a larger deal, a big, $100 million manufacturing company, that's likely to be owned by multiple shareholders, I'm guessing, versus a $5 million manufacturing company or a $10 million manufacturing company where it's like the founder who typically owns the entire thing, maybe with a trust or something like that. Is that fair that there'd be multiple owners in a larger deal and probably dealing with one or just a family on the lower end?
That is true. And we've dealt with things where like maybe there were 3 to 5 owners in a business. Obviously, if it was like a publicly traded company, more than that. But a lot of the businesses we're buying that are like owner operated or family owned, it's more than one person owning them. And that's always a unique, interesting situation because sometimes those different owners have different interests or different things that are important to them in a sale. And,
I would think so. Yeah.
You got to work through all those things to try to satiate their needs and desires for how that business ends up once it's sold.
Hey, it's John. Look, if you're building to sell, I want to let you know about a resource you may find helpful. It's called the Value Builder Score, and it will evaluate your company in the same way that acquirers will look at your business. It'll give you a score on the 8 factors that drive the value of your company. You'll also get an estimate of value and things you could do to improve that value over time, whether you want to sell now or in a decade from now. Knowing how the movie ends, I think, puts you in the catbird's seat, gives you all kinds of negotiating leverage. So it's available exclusively through a Value Builder advisor. So talk to your advisor. If you don't have one yet, you can go to valuebuilder.com/score. Let us know what industry you're in, and we will connect you with an advisor who specializes in companies like yours. Just go to valuebuilder.com/score. Yeah, walk me through that. I'd be just curious to know how a clean business with one owner, one founder to deal with is sort of different than multiple stakeholders. Like if you've got multiple stakeholders, is it just a kind of a partnership group of operators, or is there usually some kind of private money invested where you're dealing with like other investors who would like what's typical for you at the upper end?
Yeah, it's usually a situation where it's a group of people, 3 to 5 people that own shares in the business. And it's pretty rare that it's all equal, frankly. Usually it's happened for one reason or another, like maybe 2 or 3 folks got together, bought a business, and then maybe they gave some of the equity to the management team or something like that. And you end up with definitely competing interests based on size, and then just also based on, what matters to them qualitatively as well. And
walk me through some examples. Like, can you share a story, obviously names aside, of companies that you've dealt with, like maybe a bunch of competing shareholders and stakeholders that maybe wanted different things out of a transaction?
Yeah. So one that was, and it wasn't bad. It was just, slightly different views of the world. We bought a company a couple of years ago where there were 3 guys. They were in their 70s, so they were kind of looking to sell, at some point. Interestingly enough, they had tried to sell the business 2 or 3 times before using an investment banker, and that they didn't get the value they were looking for back then. And one guy, interestingly enough, was a former investment banker. Another guy was an engineer. Another guy was a lawyer by trade. And they had bought this business, and they had bought it out of bankruptcy many years ago. And they did a really nice job with the business. And they built it into a much more profitable business, grew it over time. And it was kind of interesting because how I thought it would kind of go was, or how I thought the personalities would be based on just reading them on paper before I met the guys, was not how it, necessarily went. I kind of thought the engineering guy would just be, math, science, logic guy. It was interesting because he was a little more concerned about the employees than I expected. Now, it turned out later that his son-in-law worked in the business, which is why that was true. Which is actually, that worked out great. That guy is phenomenal. I'm glad the son-in-law is in the business. He's doing a phenomenal job in the business. And then the lawyer was just kind of like, all right, time to sell, whatever. And then the banker was more like, just transactionally focused and whatnot. So I thought that was kind of interesting. And it took a little more time to get that deal done because what ended up happening, we identified that as a target that we wanted to buy. So I just called the one guy directly because a gentleman I knew him personally. And so he my friend had introduced us. And so I called him and just said, hey, do you want to sell the business? And he said, you know what, we would love to. And because we didn't have an investment banker in the transaction, it took a little bit longer, about a year. A lot of transactions are kind of more like 6 months or so, which is fine. It worked out well in the end. It might have been a little faster with an investment banker involved, but we kind of did our own investment banking work and, came to a conclusion, and it all worked out well for everybody in the end.
How do you guys think about valuation?
Yeah, it's a pretty simple way that we think about it. It's kind of, there's two kind of ways to think about it. The way we think about it is we apply a multiple to a adjusted EBITDA number, which is a shorthand form, a rule of thumb for the long form, which is discounted cash flow analysis. And EBITDA is a reasonable gauge of operational cash flow, I guess I will say. And so, what the industry does a lot of is apply a multiple to that EBITDA, which gets you to what's called a total enterprise value. And then that's how we tend to think about it to start with. And then we'll build a more detailed model that models out the capital structure with debt and cash flows, and think about the discounted cash flow as well, so that we're within a reasonable number. Kind of come at it both ways, but that's generally how we do it. Is to start with is a multiple times EBITDA.
And what would swing that multiple? Like, give me a range of what would be kind of the low end and what would be the high end, and then I think I'm curious to know what would skew the value of the high end and what would skew it to the low end in your mind.
Yeah, great question. So we've bought businesses for under a 4x multiple, and we've bought businesses for an 8x multiple or higher. And it really is a function, frankly, of risk, and then also how much the business can grow in the future. How well is it set up as a platform? And or how much work do you need to do to get it set up as a platform? But
what do you mean by platform?
Yeah, so platform meaning that you can buy the business and then you can use it as a basis from which to launch either new organic ventures, right? So new products, new product launches, new market entries, new geographic entries, new channel entries. Those would be your kind of four main organic growth opportunities. And then your non-organic, or also what people would call acquisitive, would be acquisitions. So bolt-on acquisitions, also, merger or amalgamation would fall in there, joint venture would fall in there, partnership might fall in there as well, but it's not organic. You didn't build it from scratch. You went out and bought something or partnered with somebody to grow the business. And certain businesses are better set up as a platform to either do organic growth or acquisitive growth. And usually the characteristics of something that's set up as a better platform are such that they have much better systems, processes, and people. The people being the management team primarily. Although folks that come in all day, every day, and execute the tactics and the strategy of the business are exceptionally important as well. And they're usually facilitated by the systems and processes of the business. So those sorts of businesses that have those characteristics are more, it's more easy to grow those sorts of businesses either through organic activity or acquisitive activity.
And so you're kind of 4 to 8 plus X times EBITDA or adjusted EBITDA. Mm-hmm. And on the high end, you might get up on the high end of that multiple range if there's super durable, like low risk revenue. I'm assuming like recurring revenue would make it much more predictable. And there's a lot of growth potential that you would see in the future. What's the inverse of that? Like where would you be, at the lower end of that multiple range? Like what sorts of attributes would you see and think, we gotta stay conservative and stay at the low end of the range?
Yeah. So if the business if it's too small to have strong systems, processes, and people, that's an issue. If the EBITDA margins are lower, that can sometimes be an issue, just because it may mean the business is not well run. If it's a situation where it's in a industry that's maybe more risky or underloved, that can be both good and bad depending on what's going on, in the situation. But things like that, or like, you could see like customer concentration risk. Generally, I'd say a good rule of thumb that's kind of interesting is that if a business has one customer that represents 20% or more of the EBITDA of the business, you're going to see a discount of 1 to 1.5x multiple. So if something would normally sell at like 6x, but you've got one customer that's 50% of the EBITDA, it's going to probably be like a 4.5 or 4x sort of multiple.
What if that customer is a large, heavily diversified business? Let's pick an example off the top of my head. I'm thinking of like, Procter & Gamble. Procter & Gamble is obviously a giant conglomerate of a bunch of different brands. And some of our listeners would, they'd have an in with one brand manager and they start to kind of daisy chain across to different decision makers, different brands, maybe even different divisions of the company. Like, are you rolling all those together and saying Procter & Gamble is one customer and you happen to have 3 or 4 different relationships? Or are you treating them as 3 or 4 different customers for the purposes of diversification?
Yeah, great question. So, and the answer is it depends on how decision-making is done. So if decision-making is done in a very concentrated, structured way, where it's like one person making all the decisions, then that's more concentrated and concerning. However, to your point, we've been willing to accept a certain amount of what normal people would say is concentration risk, because what we found is that either the manufacturing plant that's buying the thing that we're making, the decision is made at that manufacturing plant, right? And there's like 100 of them in the world, and we're not so worried about that because it's not a centralized supply chain process, right? Or it's like it's a big box retailer and it's a decentralized merchandising process or something like that. That's less risky than a situation where it's very centralized. And if somebody decides that day that we're outsourcing this to China, well, you just then lost 50% of the EBITDA or something like that, like as I described, versus if it's like 100 plants and it's like, okay, one plant decided, we don't want to, We don't want to use you. So, and a lot of that's very like industry dependent, right? We have one portco that they sell into the steel industry.
Into which industry?
Steel making.
Oh, steel. Okay. Yep.
And what's interesting about steel, the steel industry, is that a lot of the purchasing decisions are pretty decentralized, because, and it makes sense actually. The reason why that's the case is when steel gets made, like literally each furnace out there kind of makes steel a little bit differently, right? So you can even see like different steel making processes at the same plant because they have different furnaces. And so that's one where it's maybe a little decentralized, where you might have like a Cleveland Cliffs or a U.S. Steel is your customer, but their plants they have a lot of input into the into the decision making. Whereas there are some other things out there where like purchasing is very, very centralized, and that's a bigger concern if that's a big percentage of the EBITDA.
Walk me through, if you could, a typical structure. And it's probably like, every deal is unique, and I appreciate that. We have talked to some private equity folks who said that, there's some basic kind of contours of a typical PED and deal. And they are typically, they'll put a value on the business, whatever, it's 6 times EBITDA is the price. And they'll say, okay, we're going to buy 65%. And then we're going to ask you as the, ownership group that's selling to roll 35% into this deal. Are you using something similar in the way you typically structure? What's your sort of go-to model?
Yeah, so we are very flexible on that. The only thing is we want control. And just because generally the businesses we're buying, they need to be improved and transformed. And we found over the years that control matters for doing that. The other thing I would say that's a little bit of a hallmark of Speyside deals is that we don't tend to like to use a lot of debt. And so we like to keep the leverage ratio under a 3x. Which is not atypical for the size of businesses we're buying, up to 5.
Explain leverage ratio.
Okay. So leverage ratio is basically how many times EBITDA is the debt size.
So if you've got a business with $1 million of EBITDA, you might borrow up to $3 million.
Correct.
Got it.
Exactly.
Got it.
And the reason why that matters is that leverage ratios are important because they determine essentially your debt service. The higher the leverage ratio, the more your debt service. And also the higher your leverage ratio, the more you're getting into more exotic debt structures like mezzanine debt or something of that, venture debt or, something like that, where it's a higher yield because it's got more risk, right? Because it's further away from away from the collateral in the cap structure. And we tend to not want to do those high leverage ratio sorts of cap structures. And the reason why is it goes back to if you've ever run a business that has a high leverage ratio, it's really painful and it hurts. So if you're buying something that you want to like change it a little bit or transform it to help it grow or help it improve, trying to do a lot of debt service while you're trying to do that is like fighting a war on 2 fronts. And it is soul sucking for the management team because it's like they're always constantly thinking, all right, how much cash is going to come in the door today? And then where am I going to send it out? Knowing that they have to make the debt service payment. Now, you're not going to make debt service payments on a daily basis. But if you have a line of credit or something, sometimes the line has to be paid down depending on the terms of the line and yada, yada, yada. So we tend to like to use low leverage ratio, low debt service structures to buy companies, which tends to mean, we'll over-equitize it, but it's good for the management team when we do that. It's a little more conservative. But we just feel like that's the right way to do it because that way we can, then make the business better. And then we can take that debt capacity and invest it into the growth of the business. which is really really good as well. And
so you're
going
to lever it up to 3x, not always to 3x, but you're comfortable up to 3x the EBITDA, which basically means that you're using the profits of the company that you've purchased to service that debt effectively. There's enough profit at the end of the month, at the end of the year, to pay the debt payment without having to go to some giant piggy bank at Speyside that says, hey, we need money. The business in and of itself should be generating enough cash to pay down that debt if you keep the leverage ratio low. When you borrow that money, are you using the collateral or the ability for the acquisition company, the company you're acquiring, to pay back that debt, to underwrite that debt? Or are you effectively co-signing the loan as Speyside in the event that the company isn't able to pay for whatever reason, Speyside will come in with its giant checkbook and cover it? Do you know what I'm asking?
Yeah. So generally the debt that we put on a business is collateralized. Meaning there are assets to back it. And there's kind of two types of assets. There's fixed capital and there's working capital. So usually with your term debt, it's collateralized by the real estate and the machinery and equipment. And then a lot of times we'll have a line of credit. And a lot of times we do ABLs, which are asset-backed lending for those lines of credit. And those will be backed by the receivables and the inventory of the business, which what's really nice about those is they're super simple, frankly, because what every business will do for any line of credit, it doesn't matter whether it's a cash flow line or an ABL, you have to calculate some sort of borrowing base or like basically covenants, things like that, to let the bank kind of know where you're at and why you're borrowing, what you're borrowing, and whether that's reasonable, whether the balance sheet, the assets of the business can support it, right? And so that's kind of how it works.
Forgive the question, and it's my ignorance coming through, so just forgive it in advance. But if the business has the capacity to borrow up to 3 times its EBITDA, just on the virtue of the quality of the earnings, why would anybody sell? Like, why would the management team just say, let's go to the bank and borrow 3 times our EBITDA and go do whatever we want to go do because they're going to give us the money? Like, why would they ever sell if the underlying company itself could borrow all the money they would need to grow it?
Great question. And the short answer is, sometimes sellers or owners of businesses want to monetize the asset, and they don't want to continue to own it and run it or what have you. And it's tax advantageous oftentimes to do it because you're going to pay long-term capital gains tax. However, what a lot of businesses will do, to your point, is they will lever up the business 3 times, and then over a 3 to 7 year period, they'll pay down the debt, right? And then with that levering up, they'll take a dividend actually, and then pay down the debt, and they'll just keep doing it. It's like kind of like a sawhorse, or like a saw blade, right? Up, down, up, down. And you can do that over several cycles. So that is an option for sure.
Do you compete against that thinking?
Generally, no, because once people decide they want to sell the business, they're gonna kind of sell the business. But sometimes they'll hire a financial advisor, and which is good, because then anybody selling it, we do this too, right? Because we sell businesses, right? And we're constantly thinking, okay, should we hold it or should we sell it, or what do we all want to do with this business? And we think about that as well, and sometimes we'll hire consultants or financial advisors to help us think through that. And I think it's a really good thing for anybody to do, so that you get kind of a dispassionate third-party view of what's going on. But generally, the reason that people sell businesses is they have something else they want to do, or maybe they're older in life and it's time to retire, or they don't have any kids that want to take over the business, or whatever the reason happens to be.
What was the most surprising thing for you the first time you were a seller of a company? It occurs to me that you started as a buyer.
Yeah.
And you bought some assets, and of course, as a buyer, you got your negotiating hat on. You're trying to get the best deal possible, lowest price, right? But then you became a seller, and you were walking in the shoes of the people that listen to this show, who are trying to maximize the value and negotiate from a position of strength. So I'd just be curious, like the first time you sold, like what was surprising about wearing your like sales hat?
Yeah, great. Yeah, so really good question. And the answer is because you're in the business all the time, you think it's really simple. But like when buyers come in and you're trying to explain it to them, it's not as simple as you think it is because they don't have the history that you do. So it's like you gotta definitely be a little put your patience hat on to explain it. And you'll get questions where, some people will come in and they'll just completely get it. It clicks immediately because they have some sort of, previous experience with the industry, or, they're just really smart folks that, they do a lot of it, and it's just, they're able to pick it up for one reason or another very quickly. But there are some really, really highly educated, smart people where it's like, all right, I need to remember if I can, the more simply I can explain this to help somebody understand it, the better, because it's not everything's as simple as you think it is, because, you have the benefit of, could be months or years or decades of experience. So that's probably the biggest thing to me. It's like, okay, wow, most of these businesses are not as simple as we think they are. They're only simple to us because we've been dealing with them for so long.
That's really good feedback for our listeners, because of course, every one of our listeners, most of them started their business. So not only, did they own them, but most of them started them, gave birth to them. And so they know them intimately through their entire life story. So as an acquirer, communicating what they built to an acquirer, it can be hard because it's hard to read the label from the inside the bottle, and it's hard to be an outsider for the first time.
I think the other thing that's interesting, if you've run a business or you've owned a business, even if you're not running it as the owner, you put a lot of blood, sweat, and tears into that thing. And, the guy or gal that's going to come in and buy it from you, they didn't see all the struggles and the late nights, and they don't know what you went through. So, they kind of look at it. You don't be upset. I need to tell myself this when we sell businesses. Remember, they're kind of thinking of it as a dispassionate third party. So they don't realize, they don't ascribe the same value to it sometimes as you do, because they don't understand the struggles and the challenges you went through. To do it. It's kind of like raising a kid, right? I mean, it's like, you love your kids, and a lot of the reason you love them so much is because it's like, helping them out as they've, matured, right? You're like, oh, wow, look at what they've achieved. And you see it more through their eyes than somebody looking at it from the outside, right? And you that that kid, I don't know, became all-state in lacrosse, and they did it on a sprained ankle and a dislocated shoulder, right? Where it's like everybody else just sees, well, yeah, the kid scored, 70 goals that season and had 100 assists and, set the, Ohio state record for assists in a career, but they don't know that the kid did it on a sprained ankle and a dislocated shoulder, right? They just see the result, not the trials and tribulations. And that's a lot like what a business is too, right? Where when you're in it and every day you realize how monumental some of those achievements were. And so you may ascribe a little more value to it as the owner versus the buyer. And it's a good thing I always have to remind myself that when we go to sell something.
How do you stick handle those conversations with an owner who has a let's say, emotional connection to the value of their company and makes no rational sense what they're saying. So you say, we pay between 6 and 8 for a business like yours, and they're like, yeah, no, I get that's what you pay, but you don't understand that we got through this crisis a year ago, and we want to be paid for that. How do you sort of talk business owners through the fact that you're only going to pay, like a financial buyer would pay, not an emotional buyer?
Yep. This is why having like an investment banker or an intermediary is really, really helpful, I think, because they are, they can be a good investment banker or business broker is like invaluable in one of these processes. And the reason why I think that is that they do a couple things. Number one, they do a lot of like what I would call missionary work with sellers in terms of educating them on how processes work and what to expect and what's reasonable and whatnot. And that's kind of where your question falls. But the other thing that they do that's extremely, extremely valuable is they're like almost like a relationship counselor, because when you go into like exclusivity phase in the LOI, right, you and the buyer and the seller are at the same point. Okay, you're going to buy the business for this amount of money in these terms, and then you do due diligence, and there'll be some point in the deal where you guys like kind of like go apart of your views. Well, great investment bankers and brokers are really great at bringing you back together, right? And those folks are very, very helpful for doing that. But businesses where we haven't had a investment banker or broker, we do a lot to try to set expectations up front and tell people like, hey, this is how we think about businesses and how we think about valuations and whatnot, so that, and we understand like, some of those discussions may get, emotional or maybe almost even illogical at some points. And that's natural, right? We understand that because we've sold businesses too, and we like our babies too. So
how much erosion would you coach an owner to expect between LOI and share purchase agreement?
It really depends on the business. So I would say the answer is 0 if with perfect information, or it should be 0 with perfect information. If there's not perfect information and there's imperfect information and the information that isn't available is negative, then the erosion will be proportionate to the negative information that gets discovered in due diligence. But, and it also depends on the PE firm that you deal with, right? So it's kind of funny. We tend to be at Speyside, we tend to be very direct, open, and honest, which sometimes is not good because we'll lose. We won't make it into the management presentation because we're pretty good as operators of understanding the business. And so we'll think through, the things that are positive for the business and then detractors for the business. And we try to come up with a really realistic valuation for the indicative bid and or the LOI. Whereas a lot of PE firms, I hate to say, they'll play games, right? They'll come in and they'll bid high to get into the process with the idea that they're basically going to play a time game where essentially they're going to erode the value, knowing they're going to erode the value over time, even though there may be nothing wrong with the business, in the hopes that the seller will just get deal fatigue, and at the end they'll just say, "Fine, I'll sell it to you at a discount." We don't. I don't know. I think that's disingenuous, and we have discounted purchase prices in the past, but it's because we've something negative we learned in business. We don't go into the process thinking, "Oh, we're gonna bring it down." Now, what's interesting is a lot of investment banks, they keep statistics on these things. And I remember talking to one investment bank because we were selling a business, and it was interesting. We got this pretty nice bid from this one other private equity firm, and the guy said, "Hey, you don't want to go with them." And we said, "What? Why is that? They're pretty well known." And they said, "Well, we've looked at 100 deals with them, and on average, from indicative bid to close, they reduced their purchase price 28%. And interestingly enough, the standard deviation on that is about 3%. So basically it's 25 to 30% is like, 70% of their prices. So they clearly have that firm clearly has a strategy and tactic that they're going to try to reduce the purchase price from 25 to 30%, during the deal due diligence exclusivity phase. So you got to be, sellers have to be careful with that. I mean, we think about it as well.
What would your number be?
How much do I think the average private equity firm reduces?
No, how much did you guys do at Speyside? Like if it's 28% of the PE firm that shall remain unnamed, what would it be for you guys?
Oh, probably like 5%.
Right. Okay. So not a quarter,
no.
but it happens. And as you point out, it's usually because you've identified or discovered something during diligence.
Yeah. We're going to come back and say like, hey, look, you kind of failed to mention this thing. Like a good example, just to give you one. We bought this one company and they failed to mention that there was a fuel tank buried on the property of one of the plants. They knew it was there. They just were hoping we wouldn't discover that the fuel tank was buried on the property. Well, that's kind of their fault. That should have been discovered in the phase one environmental that they did. We did our own phase ones and found it. And so as a result, we took about $1 million purchase price reduction because that's what it was going to cost to remediate the buried fuel tank on the property. I would argue that, I mean, it depends how you want to say that. Like it was, the purchase price was like $45 million. So, that's 2%. Like 2.5% or something like that. But I would say like, that's kind of not our fault. Like, like anybody would have, we'd have just reduced the purchase price in the beginning if we would have known that was there.
What made you confident to consummate that deal, knowing that the sellers had hidden something material from you? Because I think a lot of buyers, and certainly we've heard on the show, they would walk because they would get cold feet, right? They would say, well, what else don't I know? I found the tank that you didn't disclose in your environmental, but what else is kind of hiding behind closed doors? Like what made you confident to continue on that deal?
Yeah, so we did the environmental on all the other plants and got, pretty deep detail and got comfortable. And, you're always going to find something. So that's not, I don't know, you got to have a little bit of thick skin in this game. I feel like, it's like, it's hard for them too, right? I mean, when you're putting together, the amount of data that like people request and, the bankers and the intermediaries try to get to sell a business, it's hard. It's probably such that you'll miss something as a seller. For us, as long as we feel like you're not completely being nefarious, we'll work with it. But you're right. If it's a situation, we have walked away from things in the past where we're like, guys, this feels like you are really trying to hide things, and you're going out of your way to avoid talking to us or explaining things and whatnot. Then we will walk away for sure.
How do you feel about competing in a competitive bid process? You mentioned the 370-year-old guys, the lawyer, the engineer, and you called them up and you did a proprietary deal. The other side of that coin, of course, is where, if you do a prop deal, oftentimes that erosion, the retrading becomes worse and worse because there's no one else at the table, which is why these M&A banks want to create competitive tension, get multiple bidders. From a buyer's perspective, how do you feel about it when you're, there's a competitive sort of bid situation that they're trying to, play you off of another potential buyer?
Yeah, we understand it's part of the game. But I will say that what's interesting with us, so we'll get a lot of investors who will ask us, hey, do you have proprietary deal flow? And the reality is PE firms will try to tell a lot of investors, what are called LPs, limited partners, that they have proprietary deal flow. That's almost always not true. We don't tell LPs that because it's generally not true. What we do have, though, is a proprietary process that tends to land us in situations where processes may not be that competitive after the management presentation. And the reason why is that we're a lot of times buying businesses that need to be structured significantly and then need to be transformed after. And we'll buy businesses up to $500 million in revenue, and that's considered lower middle market. What's true about that is smaller private equity firms don't tend to have the structuring chops that Kevin, Nick, and myself have to be able to.
What do you mean by structuring?
Yeah, the ability to deal with like environmental issues, pensions, sellers that have unique tax needs, or needs for how the business needs to be run after it's sold, because maybe there are going to be family members left in it. People that need to sell a business and they need to do a press release that says a certain enterprise value, things like that. Whatever. A lot of it comes down to dealing with assumed liabilities, though. But so anyway, just to finish my explanation real quick. So, if you think about the Venn diagram of the smaller firms that have structuring abilities, and then the fact that like larger firms don't want to come down into the lower middle market to do transformations, the overlap of the people that can do both, it tends to be very minimal. So for us, we're oftentimes looked at as a godsend to a seller because we will get a difficult deal done. And we'll do it very fairly as well. We're headquartered in Michigan, right outside of Detroit. So we're not the guys coming from Manhattan or LA, to do a deal. Most of private equity is either in New York City, some in Chicago, and a lot in LA. But so we're Midwest guys that are willing to do the hard work, the structuring work, and the transformation work. So after a management presentation, a lot of times other folks drop out because it's too hard for them. And we don't shy away from hard work. And we get pretty excited about working with sellers where they're in those sorts of situations because it's very intellectually challenging and stimulating.
I'd love to describe for my listeners how you make money, how you and Kevin and the partners kind of make money. And I'm going to just tell you what I understand to be the case, and then you correct me where I'm wrong. So you have several funds, FUNDS funds, where you'll raise you'll come up with an investment thesis like, hey, we're going to go buy manufacturing companies that have a little hair on them. They need some transformation. They're going to be in this revenue band, these characteristics. Then you raise money from what are called limited partners. So these are people who are going to invest in that fund, almost like they would be investing in a stock fund or some other, but it's a private investment. They're not. It's a private investment. Oftentimes, those limited partners have that money kind of locked up for a period of time. And the quid pro quo is that although it may be a little briskier than buying the index on the stock market, they would expect to get a higher return over time. And you guys, the private equity group, make money two ways. One, there's a carry or like you get a piece of the action as you improve the value of the things you buy, as well as there's a management fee just to kind of manage the fund. How am I doing in terms of trying to dumb this down as best I can? Have I got it, or tell me where I'm wrong?
You've nailed it pretty well. So, and this, interestingly enough, this is a bit of a point of contention and maybe a little bit of controversy even over especially the last 5 to 10 years. There's a really good video out there. If you type in to Google Warren Buffett, private equity is fraudulent. He goes through and talks about this, and you're right. What you'll hear in the industry is 2 and 20. So yes, we will raise money, and then we collect a management fee. On average, in the industry, it's 2% of whatever fund you're managing, and then you get 20%, which is what you just mentioned, the carried interest, simply referred to as carry. And what that is basically 20% of the deal profit. Now, the theory here is that the 2% is just meant to be able to, or meant to allow you to basically run the fund and keep the lights on and pay your staff and things like that. You're not supposed to get rich off the fees, off the 2%. Where you're supposed to do well is on the carry, and everybody should want you to do well on the carry, because if you do well on the carry, it means the LPs did well on their investment as well. And it's generally a 7 to 10 year hold period, so it's a little bit longer. And the part that's a little bit controversial about this, and I actually agree with Warren Buffett on this. You see a lot of funds over the last 5 to 10 years where they're only generating a 2x MOIC, which is 2 times multiple of invested capital. And what that means is if an LP gives me $1, if I'm giving them a 2x MOIC, after 7 to 10 years, I'm giving them $2 back. Well, here's the problem with that, right? Is if I'm only giving them, and funds have been private equity funds have been kind of underperforming the last the vintages that are coming due the last 5 to 10 years have been kind of doing like a 2x. Well, the problem with the 2x over 7 years is that's a 10% return. Well, you know what else is a 10% return? The S&P 500.
The index, yeah.
And the problem with that 10% return for private equity that I just, calculated is that that's gross of fees and carry and taxes. So when you throw in fees and carry, the 2% and the 20% and the taxes that are anywhere from 23.6% up to 37%, depending on long-term capital gains or ordinary income, you're talking about net return of 5 to 6%, and it's not as liquid as the S&P 500. So that's why Warren Buffett says private equity is fraudulent, and he's not wrong, because why would you ever invest in a liquid asset that's getting a less return than the S&P 500? So for us, to make it a little brief and short, how do we make money? Really, what we as funds need to be doing is we need to be generating more like a 3x MOIC, and what that means is that then we're getting more like a 14 to 15% return over 7 years, or something like that, and then we're not fraudulent, like Warren Buffett says. But what you've seen a lot of guys do, which, if you're an LP, is a little bit stressful, I would argue. I guess I'm an LP in my fund. I'm not an LP in other funds. But, you see folks get, just raising bigger and bigger and bigger funds. And the reason why they're raising bigger and bigger and bigger and bigger funds is because they want to go out. They want to get rich from the 2%. And the problem with that is that's misaligned in terms of getting returns for your investors. So it's a very interesting industry, and venture capital funds, private equity funds, they're kind of similar. Hedge funds are a little bit different because you have redemption, a little bit better redemption ability there. But that's kind of what's going on now. Some of these funds also can do really, really well. And what you're seeing a trend is kind of a barbell situation. So it's small funds like Speyside that are very highly specialized, right? Where we like to buy lower middle market manufacturing businesses and transform them, right? We're not a huge fund. We just raised a $300 million fund. And then, so you see kind of guys under $1 billion, and then you guys see mega funds that are over $5 billion or $10 billion. And there's some argument for being really big because, with scale, you can sort of bully the pot, so to speak. Think of it as to use a poker analogy. and usually kind of they do like multiple strategies that are pretty focused. But if you want to get what's called alpha, which is like you outperform the average basically, then you tend to see guys that are a little more focused, like Speyside is, and they have some reason for being focused, like they have some sort of experience in that area that allows them to be better at it than the average person or average investor.
So are you guys hitting that 3x hurdle rate on MOIC?
That's our targeted goal when we do underwrites for deals that we want to buy, and that's pretty typical of a lot of funds. We just tend to be a little more conservative about the sorts of things we'll buy and how we might hit that sort of thing. Like we like to figure out a way to make everybody money, and the way we make money is a little bit different than what you'll see in a lot of private equity funds. They'll do a lot of financial leverage and or financial engineering. We tend to one of our LPs said we make money the old-fashioned way, which is we buy a company and then we're very much looking to improve the EBITDA, the profitability of the company. That's how we make money. So like we've earned it because we've gone in there and we might buy something with like 10 million of EBITDA, and our goal would be to make it 20 million of EBITDA in 3 to 5 years.
That's super helpful. Before I finish off on this, the MOIC stuff, and forgive me if you can't answer or don't want to answer, that's totally fine. The reason I'm asking this question is because I'd love my listeners to understand how aligned your interests are with theirs. And the question is, what proportion of your net worth personally is in shares of your limited partnership? Like how all in are you personally in the funds that you run?
Yeah, the answer is very all in.
Like more than 75%?
Yes. Yep.
Wow.
Yeah, and I love my job. I'm also kind of boring a little bit, I guess. I would say
it's great podcast guest. So boring.
Well, boring from the perspective of like how I live my life, I guess. Like I don't have 2 homes in the Hamptons or things like that. I really, really love buying manufacturing businesses and thinking about how to make them better. And I don't live an extravagant lifestyle or anything like that. And I tend to do a lot of philanthropy with the money I make. I really like to help out disadvantaged kids, dogs, and military veterans are like the three big things. So I donate a lot of money to those causes. But I love doing what I do because it's like the most intellectually challenging thing I think in the world to do. So like I joke, there's a guy that I'm friends with who he runs a much larger private equity firm, and he was trying to buy one of our businesses and then tried to sell me one of his businesses. But I was joking with him, and I told him I would actually do my job for free, or at least the part of it where I get to buy really cool companies and interact with really cool sellers and then do really cool transformations. Like I just, it's the most fun job you can have in the world. And so I don't get too worried about, I don't know. My son gives me a hard time. He's like, why don't you buy a Lamborghini? Why do you have a 5-year-old Chevy truck that you drive? And it's like, well, I like to take the dogs out hunting, and I like to go fishing and scuba diving and coach rugby. Like I don't want a Lamborghini like that. I live in Michigan. It snows there. It doesn't make sense.
Before I let you go, I'd love to ask you about one line of questioning around operational improvements. So you mentioned your strike zone is like find a business with 10 million in EBITDA and over several years, juice that up to 20. I realize you've just used that as a hypothetical example, but you made several references to this idea of operational improvements and getting the business operating in a more efficient fashion. What are the kind of lowest hanging fruit in most of the businesses that you look at? Yeah. Where do you start?
Yeah, so we have a systematic approach for that. We call it the Portco value creation system. It's two phases. Phase one tends to be operational improvement, and that's bringing the EBITDA margins up to industry standards. And then phase two is the growth phase. And what I'll tell you is that in phase one, there are 18 methods or frameworks that we have for doing that. But if you were to Pareto it out and do the 80-20 rule on it, tell you the 20% of things that create 80% of value, it's three big things. Number one is aligning and incentivizing management teams. We see a lot of situations where the company is in a misaligned ownership structure, and therefore the management team is maybe a little bit, underloved, and therefore the business is undermanaged and underperforming. And we like to spend a lot of time understanding those situations and making sure that everybody's on the same page of how the business is going to create value. Number two would be the rationalizing revenue portfolios. And what I mean by that is most small businesses have a challenge with the customer, the business that they have that creates the revenue, right? So what we tend to find is that there are product families and customers and sometimes manufacturing plants that are not nearly as profitable as they should be, because usually it's because they haven't been looked at. And there's a reason for that, which is that smaller businesses that we like to buy tend to struggle with processes, which means they tend to struggle a little bit with systems, ERP, especially implementations, which means they tend to struggle with cost accounting, which means that they tend to struggle with pricing, which means they tend to struggle with margin management. And if you struggle with those things, a lot of times your revenue portfolio can be off kilter. So we'll come in and kind of try to understand that and manage it a little bit better. And, where it makes sense, we'll, deal with pricing or deal with customers or product lines that, don't make sense, divest. And then the third thing is optimizing operational footprints. Both manufacturing and supply chain situations, but a lot of it's manufacturing. Especially businesses we buy from, carve outs of bigger companies or maybe a bigger fund or, public to private or, even a debt to equity situation. They've been undermanaged, and therefore their manufacturing footprint is bigger than it should be. We've bought a lot of businesses where 7 plants should really be like 4 or 5 plants because of the capacity utilization, or, instead of having 10 suppliers for one thing, they should have like 2, things like that. It's just kind of like it's return on effort and time sort of stuff. It's a little bit common sense, but like, to be fair to folks that are running those businesses, when you're running a business and, there's a lot going on, it's a lot of times you're working, in the business day to day for 18 hours a day versus on the business, which is meaning like working on the business is how do you do continuous improvement to make it better? And sometimes you just don't have time to do that. And, because we'll come in and take a fresh look at it, we do take the time to think about it and do that. And it kind of works out. And, we'll talk to sellers and they'll be like, yeah, what you're saying makes complete sense. We just, haven't had time to do it. And, a lot of times we'll get sellers who want to roll equity because they're like, hey, and we talk to them. It's like, it's really interesting. We take a very consultative based buying approach, and you'll see these management presentations where if you turned off, if you kind of watch it without sound, sometimes you'd go, hey, who's the buyer and who's the seller? Because each side is taking notes, because we'll tell them like, hey, this is what we think about your business. We've done research and, this is what we've seen in the past. These are some of the best practices we see. Could this work here? What do you think? And they're like, oh yeah, that's a really good idea. We bought businesses in the past. It's kind of interesting where we've told them in the management presentation, like, hey, we think these are some really good ideas to maybe increase value. And they will actually have implemented those before we close, because they're like, yeah, that was a really good idea. So we just decided to do it. And we like that because again, this is the best job ever. So dealing with these folks is just really fun. And you just kind of work together to, solve how do you create value in the business sort of approach. And we've just found over the decades that that's really the best way to approach it. And yeah, you might give them some free ideas or whatever. But like in the end, whatever, it's worth it. And maybe you don't get the deal done, but a lot of times those guys will call you up and be like, hey, you didn't buy our business, but we heard about this thing over here. You should call those guys. And, you create long lasting relationships that are good for everybody.
How do you deal with a resistant manager wherein your ideas are casting doubt on decisions they've made in the past? So you mentioned that the guy who's running the 7 plants, and they probably should be 3 or 4.
Sure.
There's probably some manager in that business that has vehemently said, no, we need 7 plants. And how do you stick handle around, because to make operational improvements means you are overriding decisions someone made at some point.
Yeah. So the short answer is with a lot of data and logic and understanding. You just gotta listen. It's very important. Because here's the thing. Like I would say 9 times out of 10, when you ask those folks, hey, why is this way? They usually have like a pretty good answer, right? It's not illogical. It just happens to be a function of the resources and the information they had at the time when the decision was made. Right. So if you were in the same situation with the same information at that time, you would have made the same decision. So you got to understand that. You got to be willing to listen. Right. And that's one thing I would say, like some private equity is not so great with. Right. It's like, oh, I'm, this 32-year-old whiz kid that graduated from Harvard Business School and I know everything. And the reality is you don't know everything. You've got more data than you have wisdom and judgment. But, because maybe your background, you think you're pretty smart. Well, the reality is, I guess I found that like most people that are in these positions running these businesses, they're pretty smart people. And if you were put in the same situation that they were like, 3, 4, 5, 10 years ago, you probably would have made the same decision, right? But you got to understand that. You got to understand, like, what's the context and whatnot. And then kind of like explain, like, hey, this is the way I'm seeing it. Am I seeing it right? Like, or am I seeing it wrong? Tell me why or not. And then just kind of like, hey, we've seen this work in the past in other businesses. Could this work here? Here's why we think it could work. And we're pretty good at, explaining our ideas very clearly and simply and directly. Like I remember, like when I was a kid, my dad, he taught, math and high level math and science at the university level, and kids loved taking his classes. And the reason why was he was such a great teacher of the concepts. And I remember asking him, like, and he tutored me in math and science as well. And I'm like, God, why are you so good at this? Like, you can explain this. Like, just makes perfect sense. And he's like, son, like, something that you'll figure out in life is that people that are really, really smart, they can take really difficult concepts and explain them really, really simply, such that you should be able to understand them really well. If they can do that for you, that means they know them. They actually really know the material, right? If they can explain it to a 3rd grader or a 5th grader, if they can take physics or calculus and explain it to a 3rd grader or 5th grader, it means they really actually know it really, really well. And we, because Kevin, Nick, and I have been operators, we're really good at putting ourselves in those folks' shoes and explaining, how we see things and trying to understand their perspective, because we've probably had that perspective before. So that's a lot of like how we go about it and think about it. Now, there are times where, like, here's a really good example. We had this one company I'll never forget, where the biggest customer had the worst pricing, and they were losing like, it was like negative 20% EBITDA margins. And I remember talking to the sales guy, and I'm like, hey, John, like, why are the prices like so bad on this? It's like, this kind of doesn't make sense. Like, they should actually be pretty profitable. And, this took weeks and months of like evaluation. And what it turned out is that John played on that customer's softball team, and he didn't want to raise the price because he was worried that if he raised the price, the guy wouldn't let him still be on the softball team. And then that was John's whole identity in the town. And we were like, well, John, like, I appreciate that you want to play softball with the guy, but like, it would be literally cheaper for us to send the guy a $20 bill than to send him his product. So we're going to raise his prices. And he's like, I can't do it. And I'm like, that's fine. I will go talk to him and raise the prices. And I did. And the guy laughed and he was like, I was wondering when we were going to have this conversation. Like your next closest competitor is like double your price. And he's like, I'm happy to pay the higher prices. And John can still play catcher on the softball team. It's fine.
Oh, it's a great place to end our conversation. I could talk to you for hours, Eric. This has been super fun. You're obviously incredibly knowledgeable about what you do, but you also have a gift, like your old man, for making it simple for folks to understand, even people like me. So I really appreciate you dumbing it down for me, and I'm grateful for you sharing with our listeners as well. Where can folks, if they want to kind of learn more about you and the firm, what's the best way for them to find out?
Yeah, if you want to go on to my LinkedIn is an option. All my contact information is public there. It's also on our website. But if you just look me up on LinkedIn, my phone number, my cell number, and email is out there. Best way to probably get me quickly is text or email. It's out on our website as well. So happy to chat with folks if they have things they want to talk about or whatnot. We're always happy to discuss, especially manufacturing businesses. We love it. So it's not a job. It is a job, but it doesn't feel like a job. So feel free to.
You better not say that, because you come review time. You're like, it wasn't a job, Eric.
That's okay.
Eric's got a unique spelling to his surname, and Speyside's a little unique as well. So I will put both of Eric's spelling of his surname as well as the company name along with his LinkedIn profile, and you can get all that at builttosell.com. Eric, thanks for doing this.
No problem, John. Thanks for having me on. It was great.